Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus is on the way to you right now. And I've got Deidre Woollard with me, who is with the Motley Fool. And for those of you that don't know the Motley Fool, it's basically I guess, Deidre, would you say it's like a media company, essentially, at this point?
Yeah, I would say it is a media company. We have a bunch of membership-based services that give stock recommendations as well as retirement guidance and things like that.
Yeah. So probably most listeners certainly know of the Motley Fool. Been around for a long, long time. Probably, I remember getting stock advice from the Motley Fool back in the techboom.com era, and back then it seems like it was primarily stock advice. But Deidre actually covers real estate for the Motley Fool in the real estate space, everything from REITs to residential and kind of all the asset classes. So I'm really excited. This is going to be quite a different conversation than we normally have on the Apartment Gurus. But I know, Deidre, we were talking offline. You're going to be able to speak to some macroeconomic factors that are important to us as apartment investors. And so, yeah, I'm just really excited to have you on the show and want to say welcome to you.
Fantastic. I'm excited to be here and to chat with you.
Yeah, no, it's an honor to have you. So it looks like you kind of organize, maybe not. It looks like you organize your books like my friend Chelsea does behind you there in your background, kind of color coded almost a little bit.
No, they're not color coded, but they're not organized. I definitely need to work on that.
I know. I've got a vinyl collection of records that is like, it needs like 3 hours worth of attention right now, like organization. I can totally relate. So, awesome. So before we kind of jump in, Deidre, I'd love to hear a little more about you and your story and how you got to where you are today covering real estate with the Motley Fool. And then we'll talk a little bit, more in depth about what you do with them.
Awesome. Yeah. So I've been writing about real estate for about 2 decades. Started writing for a blog back when that was a thing in the early 2000s. That blog was part of a company that got bought by AOL. So then I was writing for real estate with AOL. I wrote for Realtor.com for a while. And then I kind of wanted to get deeper into what really happens at real estate brokerages. So I spent a couple of years at some of the luxury real estate brokerages in Los Angeles, teaching agents how to market, how to do communications, how to use social media, all of that. And at the same time, I started doing real estate, like public relations and PR, and wrote for Inside Real Estate. And when I was doing that, that's when I got recruited by the Motley Fool, because they were starting to focus more on real estate as an alternative. And so that's how I ended up writing and working for the Fool for the last 3 years.
The Fool. I love it. So 3 years with the Fool at this point. I know that you publish pretty much exclusively online, digitally at this point. Is that the case?
Yeah.
So what is your what's your kind of output look like as far as you guys do a monthly, weekly? How does that all work?
Well, it depends because there's fool.com, which is free out there for anybody. And we publish just hundreds of articles on that all the time. That is sort of like everything that's happening with every single stock, larger real estate trends as well, plenty of free REIT content. And then we have our individual services. So we've got 3 real estate based services at the Fool that are private for members. One of them is more for just sort of basic REITs, entry level stuff. The next one is a little bit broader real estate, some of the more like riskier sort of emerging tech companies. And then the third one is called Mogul. And that's a mix of REITs and stocks, as well as real estate crowdfunded projects, some from the major sites and some of them that are direct and exclusive for that membership.
Yeah. Love it. Okay, cool. So crowdfunding, I'm sure most listeners are familiar with it, but let's just talk about the basics of crowdfunding. So it's really like, it's almost like micro syndication. I'd kind of describe it as, at least that's my understanding of it. And full disclosure, as a company at Greenlight, we've never worked with a crowdfunding platform before. We've certainly considered it. We're a newer company. We're 4 or 5 years old at this point, and most of the big name crowdfunding sites want to see a pretty extensive track record from you. So, and we own 7 properties. We've done 2 full cycle, and so we're getting there, but we're not quite. When we've tried in the past to get one of our projects on a crowdfunding site, we don't quite have the qualifications yet. But could you kind of just explain in basic terms, like how crowdfunding works, what it is, and what the objectives are?
Sure. So crowdfunding really sort of started with the 2012 the Jobs Act, and that was designed to raise money for smaller businesses, emerging growth businesses, and it ended up being this really interesting thing for real estate. So you've got 2 main tiers. You've got your Regulation A, which is basically anyone can invest in these certain funds, and you have to follow certain rules. So like if you've seen Fundrise, that's a Regulation A fund, and anyone can invest in that. And then you have Regulation D funds, which are for accredited investors. So if you're accredited, you have to have a 200,000 in income or $1 million in assets, excluding your primary residence. So that's really where you see, that's like CrowdStreet or other larger platforms like that, where your minimum investment is maybe usually around $25,000. And so those are sort of, that's sort of the main kind of, there are different funds, but those are sort of the main ways that it's evolving. But I think it's fascinating because it's growing so fast, and it really is sort of opened up people's eyes, I think, to understanding that you can invest in real estate. And I think it's actually been good for syndicators too, because it has led to more awareness overall. Yeah.
Well, and here's one thing that I see from a syndicator's standpoint is like, it's a risk. To me, it's heavily risk mitigated in the sense that you can't get on these platforms as with a bad deal or as an underqualified sponsor. And so, the natural selection aspect of the deals that you'd actually be investing in as a crowdfunder, they're going to be very high quality deals, likely lower risk deals with really high quality operators, at least ideally speaking, right? Never any guarantees.
Yeah. never any guarantees. I think nobody expected the pandemic. So some of the office deals that looked really promising, pre-pandemic, and had really sort of had rates of return that they're probably not going to reach now because circumstances changed. So even having a great sponsor is no guarantee.
Yeah, true. I mean, there's things that happen that are out of a sponsor's control, and that's just the reality of investing. It's called investing for a reason. There is always inherent risk in investing, and All of us know that are listening and talking here. So, and Mogul is your platform or vehicle, or I'm not sure exactly, your service that you offer on fool.com that allows the members of fool.com, members of Mogul, to invest in crowdfunding. Is that how it works?
So my colleague Matt Argersinger, he's our lead investor on it. He started it off, and one of the things he did was he created this thing called the Mogul Score. So a lot of the deals so when he selects a deal from CrowdStreet or Real Crowd, or it's a deal that someone came to him directly with, then he rates it on a bunch of different factors, like the deal itself, what is the structure of the deal, what's the rate of return, what's the prep, what's the equity multiple, looks at the macroeconomic factors, sort of rates it in the ways that you would think about any deal.
Yeah, right. Okay. And does he end up, so he ends up rating these, and then is the opportunity then there to invest? Is that kind of how the flow works?
Exactly. Yeah.
Yeah. Okay. And I'm curious about his level of due diligence on the deal. I'm sure it's very thorough. When you said he looks at macroeconomics, is he doing like full on rent comp studies and sales comp studies and whatnot?
Well, it's tricky because with the crowdfunding sites, you only have what they're giving you, right? So you have your offering circular, you have the documents that they give you inside the deal room. So he's looking at that, and then he's also looking at the macroeconomic data that you would get from other sources to see, what are the average rents? Are things growing? What is the detail of this particular area? What other projects are being built around it? And, does it make sense, especially when you're looking at something like if it's new development, what else is being built and when is it going to come online? Because you don't want to be in that situation where all of a sudden everything comes online at the same time and your lease up is a mess.
Yeah, no doubt. No doubt. Yeah, you want to know all that stuff. And okay, so he does a pretty deep dive into these deals, which is another layer of risk mitigation when you have an expert pair of eyes on a deal, and that's what they do all day, every day. And they know the red flags to look for. They know the green lights to look for. They know the macros of the deal and the metrics of the deal as well, the IRR, your preferred return, all that stuff. Man, that sounds like an awesome service. I'll be honest with you. It sounds amazing. So listeners, one way of getting into a lot, like Deidre, just so you know, like a lot of the listener base here are folks that are either interested in passive investing or are interested in either becoming multifamily owner operators like myself, and getting that first big deal done, or they've done a deal or two or three and they're looking to scale up. Like that's pretty much the listener base here. And so for listeners, like I think one of the best ways of getting into the owner operator space, which I know a lot of you want to be, is to be a passive investor in someone else's deal. And I think that, doing this this way, where you literally have two layers of really deep dive expert pair of eyes on the deal before you even see it, is a really exciting avenue to think about doing your first deal inside of. And you may not have as personal access to the syndicator, the operator, as you would with, say, a smaller boutique firm that only has 5 investors in a deal or 10 investors in a deal, kind of like what we do. And there's advantages to going that way in terms of learning the business, learning how the deal gets done, and having kind of more insider access. But at the same time, if you want to like mitigate risk and get on into a powerful deal that's going to give you really handsome returns at the end of the day. This is legit. This sounds really cool to me. So, I know I just kind of went on a little tangent there, Deidre, but any other thoughts, any thoughts on that stuff?
No, I think what you're saying is really great. I think that when you're starting investing, it's sort of terrifying and you don't know what to think about it. But you could start very, very simply by like owning shares of a multifamily REIT, right?
Yeah.
And then you start by looking at, like one of those like apartment REITs, and you start looking at their earnings report, you start looking at what they talk about, and that sort of gives you just the smallest taste of what you can do. And then you kind of go from there, and you can invest in real estate crowdfunding, you can sort of work your way up.
Yep.
Then you invest with a syndicator, you start to see how they do it. And this is a process. I believe with investing, it's so important to be patient and to really learn all the way, because the more you learn, the more you protect yourself.
Yeah. Oh, no doubt. So well said. Like, this is a long game, people. Like this is such a patient. My dog agrees strongly with this. This is a long game relationship, long-term relationship game, very relational as opposed to being transactional in nature. And patience is not just patience. Well, I think patience is like one of the secret sauces here. And I think one of the other secret sauces is having a very clear vision of what you're doing and where you're headed, because then you have something to be patient about, right? Like, if you know that you want to get to, let's say, $100 million in assets under management or assets owned, and you're starting from, maybe a single family, right? And there's a lot of things that need to happen in that process and that time to get to 100 million. And it's very, very achievable, especially when you believe it. But sometimes those of us that really can get the belief part of it, and I'm kind of one of those people that once I choose a project and choose to believe in it, I'm all in and I know it's going to happen. But one of the things that somebody like me needs to exercise a lot of is patience. And I love that you brought that up, Deidre.
Well, I see so many people get so excited because that is part of real estate. Real estate is always emotional. And I worked on the residential side where it's more emotional, and people used to say, well, commercial is just numbers. It's not emotional. I don't know. I've seen a lot of people get very, very emotional about commercial deals. So I don't really, I think it's a balance on both sides.
Yeah. No, we're doing a $27 million acquisition right now, and we're getting close to the finish line. And let me tell you, if this deal fell apart for whatever reason, I'd be crying. I'd be emotional, and it's not because it's personal or anything else. It's just because when you work hard at something that you're passionate about and you have setbacks, it's tough, and so, that virtue, patience is a virtue. It's so true. It's very virtuous. And, there's no more appropriate place for it than in business, in my opinion.
Well, and also every investor fails. That's something that you learn if you're a stock investor. No matter what you're not. None of us are 100% right. All of us are gonna fail in little ways, and hopefully not in too big a ways. And that's why we always have to make sure that we have, we're not investing our emergency fund or something like that. We're always making sure that we're protected so that we can, when the time is right, take those big swings.
Yeah. Yeah. Well said. I love the sports analogies. Anytime we can get a sports analogy in, like taking a big swinging for the fences, I love it. I'm curious, actually, full disclosure, know very little about REITs. It's not a space that a syndicator really swims in very often, right, unless they're investing themselves in REITs. So I have a basic idea of what a REIT is, but could you kind of, give us a pretty basic explanation of a REIT? And then I have a few specific questions for you about them.
Yeah, a REIT is just a real estate investment trust. There are ones that are publicly traded like stocks, and there are ones that are private or non-traded REITs that are available usually through a broker. And they're basically like stocks, except there are a couple of more rules involved, and one of them is that they have to pay out dividends. And you can invest in all kinds of REITs. So, if you're heavily invested as a syndicator or in your private deals as in multifamily, maybe you want to balance that out with like an industrial REIT or something like that. So it's just another way to invest in real estate that's not active. You don't have control, but it's super liquid, because with a publicly traded REIT, you could get in and get out the next day if you wanted to. Not that I would recommend that, but you could.
Yeah. Yeah. And they're basically, they're entities that hold real estate, right? Buy and sell and hold real estate.
Yeah, absolutely.
And pretty diversified. And I mean, I'm sure there's different types, but, are there some that are pretty diversified across asset classes, or are they generally asset class specific?
There are a few diversified ones, but even those are starting to get more asset class specific. So I think mostly they tend to invest in a certain thing. So you've got like an example is like Kimco, and they invest in grocery store anchored retail. So that's mostly what they do. They might have a little something else, but mostly they tend to stay in certain verticals.
Got it. Okay. What are the returns like on a REIT compared to a syndication typically?
Well, it's different because you're getting a dividend, usually quarterly, sometimes monthly, but you don't make your money until you sell your stock.
Right. Well, that's kind of true though with syndications too, where you get a preferred return throughout the hold, but then you're really not cashing in until the asset sells. So you're right. I mean, I guess it just depends on how long you stay in and that sort of thing. Is there a way to kind of compare apples to oranges here, as far as like, I would think REITs are significantly less risky than investing in in a single property deal, just because you've got so much diversification. So I would think that the returns would be significantly less than a syndication. Is that typically the case? Would you say?
Yeah. So you think about it the same way you think about the stock market, right? So over time, the stock market does, it works out to 10% a year, but it's not, it's not a flat 10% a year, because, this year has been bad and some years have been great. And REITs are sort of similar to that they outperform the market over time. So they generally track around 10% or higher, but there are up and down years. I mean, the pandemic was terrible for REITs because offices closed, businesses closed. So it definitely depends. But some of the multifamily REITs, like Mid-American Apartments, which is one that is mostly Class B workforce housing, their stock is up about 55% over the past 5 years. So they've had a nice run.
Yeah, I mean, that's like the magic of multifamily. And I sometimes I feel like I'm tooting my own horn here by talking about how all the advantages of multifamily, but I'm not. I'm like, I genuinely want people to understand what an exceptional asset class it is, because and not to make it too big a deal out of one company, one REIT that did well, but look, multifamily is recession resistant. There's just no other way of saying it, and it's not too bold of a claim. I didn't say multifamily is recession proof. I said it's recession resistant, and one of the reasons for that is when we get into an inflationary environment like we're in, rents go up with inflation. So you're hedging that investment against the rise of rents and inflation largely. Now that doesn't necessarily always happen. In a very deep recession, things are different. But in a normal recession, which you can look back over history and basically get the idea of what happens in a normal recession, multifamily housing performs very, very well. And I think the key right now, and I'd love to hear your thoughts on this, Deidre, but I think for me, the key right now as an investor is to make sure that we're getting into projects that we're comfortable being in for 5 years or more. Because chances are whatever we go through over the next year, 2 years, whatever, 6 months, whatever it ends up being in terms of a recession, is going to be survivable, and not only survivable, but you're going to cash flow through that whole period as long as your debt is a fixed rate debt, and and as long as the deal pencils the way it should, you'll cash flow throughout the recession, so you'll actually be making some money. The value of the asset might go down, and that's a reality, but it's one that if your business plan is to hold the asset through that downturn and back into a better economic environment, then who cares if the value goes down in the 2 to 3 to 4 year time frame, if you're planning on being in it for 5 to 10. And look, every time we have a cycle, right, it's like we grow. If you can see me on YouTube, great. If not, you can vision the curve of the growth curve going up. We kind of tip out, and then we go into a recession, a downturn, and then we turn back up. But usually the next time we turn back up, it goes quite significantly higher than the last peak did, right? So the long game in real estate is kind of magic, in my opinion. When you're playing the short game in real estate, whether it's commercial or residential, like, number one, it's a paycheck. Number two, it's risky, it's speculative. And we really like the buy and hold model. So what are your thoughts on all that?
Yeah, I was doing a presentation. We had a Motley Fool member event, and the first chart I put up in my conversation about real estate was household formation. And that line has very small ups and downs because it's mostly just straight up and to the right. We keep making more people, and they need more houses, and so
right.
You're in this business that's it's not going to go away. There's not going to be a significant shift that results in us not needing places to live. I think the challenge is understanding the time we're in right now. And I think the time we're in right now is actually one of those really, really interesting times, because when everybody starts being scared, that's the time that there's that saying,
the Warren Buffett thing.
Yeah, the be greedy when others are fearful, right?
Yeah, right.
Which is really, really hard to do. And when you see it being a talk of recessions, talk of housing crashes and things like that, it gets scary. But that's actually the time when there's opportunity.
Yeah, I totally agree. And I think the opportunity is going to shift and change as we go through this, whatever we're going to go through here. I think now the opportunity is to just buy. It's tough to be a buyer right now because equities pulled back. Certainly the debt markets have pulled back, and sellers' expectations haven't totally adjusted yet. And so in terms of price and in terms of, the less tangible but still important terms of a contract, like hard earnest money and that sort of thing. So, you got to sift through a lot of deals right now. And you got to say no to a lot of deals right now is what we're finding. And at the same time, there are still deals out there because there's still sellers that need to sell. And the sellers that really need to sell are going to have to face the music as far as the shifts that have happened in the market. And then I think as time goes on, what we're going to see is even some more kind of, opportunistic times in terms of, people's loans coming due. Like a lot of people were doing short-term bridge loans in the last 3 years because deals were so frothy and exciting, and so they used this a short-term bridge loan to get the deal done at a low interest rate, and the interest rate might be adjusting in the next year, or usually those are 2-3 year type timelines. So, or they might even be coming due. And so you're going to have some sellers that really need to sell as a result of that. And, there's going to be other circumstances that really, I think will present some unique opportunities. But you got to do it right now. It's like all the things that we've been learning over the last, for us 5 years of being in this business, have to all be applied now. Like you have to buy right, you have to finance right, you have to raise capital right. And it used to be that the market was so, exploding growing rapidly for such a long period of time. And that forgives a lot of sins, when in your business plan and your execution and everything else. Like, there were people that were modeling deals for a 3 to 5 year hold and were selling after a year and a half because the economy went up so much, rents went up so much, they got to their target rents and their target IRR, much quicker than they thought. And I don't see that happening right now at all. And I certainly don't see modeling that as being smart. Like you got to model, to me, it's at least 5 years right now is kind of what I'm thinking. So what are your thoughts on all of that, Deidre?
Yeah, it's interesting with Mogul. We had a couple of apartment projects, value adds that sold out way faster than they were supposed to. They were supposed to be that like 5-year hold, and then they ended up being bought by somebody else after a year and a half, because partly during the pandemic there was all of a sudden that run on garden style multifamily. Everybody wanted garden style multifamily,
no doubt.
and
separate entrances.
Yeah, exactly. Any project that was that, all of a sudden there was all this like institutional money trying to buy those up as fast as possible. You just kind of never know what's going to happen. But I think you're right. This is a really challenging market for raising capital and financing right now. There is that sort of overall pullback, and there was a report that came out from CBRE recently about that and talking about the ways that the lending market might be shifting. And it was a survey of investors, and there was a little bit of concern about how where are lenders going to be looking? Are they going to be less likely to finance in the Sun Belt? Are we getting too developed there? Things like that.
Interesting. Yeah, and to me, like you said, when people are fearful, it's time to be greedy. And it's interesting to see the fear response in most of the debt or at least a lot of the debt and equity markets. But there are pockets that haven't responded. Like small banks are still, you can still get loans in the 4s that are fixed rate for 5 years. You can, a couple years of interest only payments. Like, that's still out there. I mean, there's pockets, and then there's equity pockets too, that people that see the brilliance behind, specifically, I think it's got to be multifamily. Like right now, when you're looking at asset classes other than self-storage and mobile home parks, which are like close cousins to multifamily, in my opinion, your office, industrial, depending on your market, of course, but especially office, retail, industrial, I would be a lot, if I'm a family office, like right now, I'm all about multifamily, and self-storage and mobile home parks, because the lack of volatility in those asset classes and their high performance through downturns is remarkable. It's so exceptional to me. Whether you're looking at the rest of commercial real estate or residential real estate or across other asset types like stocks, bonds, et cetera, the return factor, what you can typically achieve in a multifamily investment, and when it's measured against the volatility, the lack of volatility of this particular asset class, to me, it's unbeatable. I don't know. Deidre, if I were you, I would never write about anything other than multifamily ever again.
I love writing and studying housing in general because we're dealing with such an affordable housing issue.
Yes.
And we're not solving it in the ways that we could. I mean, you mentioned mobile home parks, which is, you can't put a mobile home park anywhere right now.
That's
Towns
right.
don't want them.
No.
And it makes it it's an interesting place to invest, because there's a REIT that I invest in that does that, partly because if you've already got the park, great. Because if you want to try to put a new one somewhere, nobody's going to let you do it.
Yes.
But we're also seeing something really interesting in terms of so in the great financial crisis, you had that run up where like Blackstone bought all those single family rentals, right? And you the last decade has been like the story of the massive single family rental institutional buyers.
Yeah, and
Right.
the builders too, the build to rent stuff. Yeah, totally.
Yeah, the build to rent thing is really fascinating to me because the single family investors right now, they're pulling back a little bit, and they've stopped buying aggressively in some markets.
Mhm.
But the build to rent thing is starting to be really more and more popular, where they're buying whole communities from home builders. Partly, I think, because right now we're in a little bit of a problem where home builders don't know if they can really count on the buyers that they thought they were going to, so they may sell out to an institutional investor. And all of that sort of makes me think about, when we over-index toward that, we sort of forget about the many different types of multifamily, because I think, we
Yep.
just talked about garden style apartments, but there's many different types of multifamily and different types of projects too.
Yeah. Yeah. Our favorite, by the way, is the townhome setup, where it's kind of like, it's basically garden style on steroids, where you've got separate entrances, just like garden style. Sometimes you have a garage even, but you've got typically 2 floors, square footage. And we found that those are by far the easiest to rent as far as desirability goes. If somebody comes and looks at our 2-bedroom townhome layout and then goes down the street to a 2-home garden style or more traditional layout where you've got interior entrances, man, we're going to get that tenant every single time. And there's nothing you can do to duplicate that. You can lower the rents on the other property and et cetera, but there's really no way of getting around like the desirability of something like a townhome layout. Just a little side note for
No, I think that's so smart. I think that's absolutely true, because we saw that during the pandemic, right? People moved out of apartment buildings because what did they want? They wanted a little more room. They probably needed to be working from home. They need home office space, but they also needed outdoor space. And if you're in an apartment building and you don't have easy access to outdoor space, and you're in a pandemic and you can't go anywhere else,
yeah,
you're not going to be happy for long.
Yeah, no doubt. No doubt. Yeah, I love my backyard. That's for sure. I'm very blessed with a big backyard. All right, so let's cut to the chase here, Deidre. You're an industry expert, and you've got your finger on the pulse of a lot of different aspects of real estate. What do you see happening here? I know it's like the crystal ball question, right? But like, where do you see us going? What do you think the Fed's going to do, and all that, like crystal ball stuff?
Right? It's so hard. I mean,
Such a fair position to put you in, right?
Right. The Fed has been, we're all just watching the Fed. I mean, Jerome Powell spoke recently, and all of a sudden the stock market just like went back down again. I mean, it's interesting because he's definitely clear that they will do what they need to do in order to get inflation back down, and that's not such great news for us. But I think one thing that I'm watching is that they were saying that it was going to be, we were going to get 8% interest rates for like a 30-year fix, 9%. There was all of that talk last year. Now the people I'm seeing predicting things, analysts and economists, are starting to say like, well, it probably won't go too high over 6% next year. So there's a moderation in there, because there's really only so far that things can go. And when there's sort of a tipping point. And I think the other thing that I'm really watching is what is happening with existing home sales and the prices. Are we at peak? Are we at past peak? My gut is we're a little past peak, but I'm not a housing bubble person. I think we're just seeing deceleration, but it makes it interesting for housing in general. And the other part of it that I'd say that I'm watching is just what's going to happen in those Sunbelt markets where things got really inflated, both for rents and for housing prices, like in Austin, Texas, maybe, or
Right.
Phoenix, Arizona, Tampa. Those are the markets that really had a run up that I'm sort of watching right now to see what's next.
Interesting. Very interesting. And I think Phoenix is already showing signs of pretty significant softening. Austin, man, Austin's a beast. That's a very unique scenario that Austin has, especially with like Tesla moving there, and who else? Somebody else huge, just
Oracle is moving there.
Yeah.
Yeah.
I mean, half of Silicon Valley is now in Austin, Texas. And
It's true.
I mean, so, but yeah, and when you have those economic drivers, I mean, you just create so much demand on housing in those particular markets, and they go crazy as far as values go. And I'm in Salt Lake City, and we started in the single family space in 2011 and did the flipping, wholesaling thing, and then got into development and building. This was before we got into our current lane, which is multifamily, which is all we do now. And it has been all we've done now for 4 or 5 years. But we saw in Utah, I mean, what we went through here was just, I mean, astonishing as far as, the raise in the median household price and wow. I mean, Austin's another better, bigger example of that. And Phoenix certainly had its moment. I mean, I think it was 2021 or 2020 that Phoenix really, really boomed as far as rents, as far as, units coming to market, and the demand stayed super high and values went super high too. So yeah, it's fascinating right now. So, I mean, you kind of see, it sounds like what you see happening is Feds are going to keep raising rates kind of as long as they can,
as long as they need to get to try to cool inflation. Yeah.
Right. And then, so that's going to induce some pain on a lot of us, on most of us. And then the Fed's going to have to they're going to have to bring rates back down to basically re-stimulate the economy. Is that kind of what you see happening?
Yeah, that is what I see happening, because depending on how long we have a recession, and I don't feel that this is going to be a long period of time. I don't feel that the housing correction that we're going to go through, that we're just kind of starting to go through, is going to be one of those long dragged out ones. And
Right.
That's not what some of the economists are seeing. They're seeing this sort of a shorter thing, which I think is interesting. We're seeing these shorter economic cycles now. And so I think that this will be temporary, but it's going to be, whenever something like this happens, this is a time where there is opportunity. So,
yeah. I know. And the smartest, most experienced investors that I know are super excited right now. So
well, I think there are two things in investing not to be afraid of. One of them is buying when prices are on the rise, and the other one is not being so afraid of taxes that you don't do anything.
yeah, good point. And in real estate, especially larger scale commercial real estate, you got cost segregation, bonus depreciation. You've got some pretty nice tax advantages in your in your arsenal, so to speak, with these deals. So awesome. Deidre, any kind of, we're running up against time here, and this has been a fascinating conversation. I've loved it. Any kind of final thoughts for us on either the current economic climate as far as it relates to real estate, or just, I know you're a real estate investor yourself. Any thoughts for kind of a beginning to novice real estate investor in this climate?
I think for a beginner, it's just a question of really learning and understanding the way the process works and how long you're going to have to invest. I think the hardest thing for people to understand as beginning investors is like you said, is that 5-year cycle, understanding you can't pull your money out, understanding what you're getting into, and being prepared that way. Yeah.
Well said. Awesome. Are you available? I mean, you media folks are super, you're famous, and I know that you probably protect your access, but are there ways of reaching out to you that a listener that might be interested in learning more might be able to reach you?
I talk about real estate on Twitter a lot. So
Cool.
Twitter, my Twitter handle is my first name. It's DEIDRE. So yeah, you can find me that way. And yeah.
Really? You were able to get at DEIDRE for yourself? That's awesome.
I was on Twitter early. Yeah.
Yeah, that's fantastic. So there you go, listeners. That's an easy one to remember, at Deidre or at Deidre on Twitter. That's amazing.
Yep.
Good for you. Thank you so much, Deidre. This has been a great conversation, and I love geeking out on this stuff. And
Yeah, me too.
I can tell you do too. Yeah, I was gonna say it's always fun to get heads together on people that kind of, like I said, have their finger on the pulse and have very informed opinions and the ability to project somewhat a little bit, at least in an informed way, doing the best you can. But like you said, nobody saw the pandemic coming. It should have been pandemic, right?
Right? Yeah.
That was a slip. But yeah, I mean, nobody saw that coming, right? So like crystal balls kind of all went out the window about 3 years ago, and how it's all shaking out it's kind of tough to project. And but we know what the Fed's saying, we know the direction they're taking, and we can get a pretty good idea of how that's going to affect real estate. And like I said, man, we're just focused on getting good deals that with long-term fixed rate debt, that cash flow in good growth markets. That's all I know to do right now. I'm not one to put our pencil down here at Greenlight. We're always moving forward. So anyway, Deidre, fantastic conversation. Really appreciate you. I wish you all the best in your journalistic endeavors and investing endeavors. And please let us know how we can ever be a contribution to you.
All right. Thank you so much.
Yeah, you betcha. Listeners, thank you. We love you guys. So grateful that you tune into this show and listen to the end of these episodes. You're doing stuff right. Like this, getting this specialized knowledge under your belt is enriching. It's enhancing. It's going to make you a better entrepreneur. It's going to make you a better apartment investor. And hopefully you keep tuning in. Leave a rating and review if you feel inspired. We love that. We love to hear from you. And you can always reach me directly at investwithgreenlight.com. Set an appointment with me there for consultation, however you want to go. So thanks again, Deidre. Thanks again, listeners, and we'll catch you on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.